Chapter 10 of Financial Accounting deals with accounting for long-term liabilities. So primarily it's going to be bonds that we talk about in this chapter, and bonds are a very important financial instrument to understand. So bonds basically are when a company loans, or when an investor or an individual loans money to a corporation. So like you and I could buy bonds or invest in bond markets, and those are corporate bonds. So again, we're loaning money to the corporation, and then what does the corporation do? They pay interest every year or semi-annually in bond interest payments, and that is going to be at the stated rate or the coupon rate of the bond. And then at the end of the life, you'll get the amount they borrowed back. And bonds are issued in $1,000 increments. So you'll give them $1,000 today, they'll give you $1,000 back at maturity, and then they will pay you interest every year. So the advantages of bond financing, if you are the corporation, is it doesn't impact the owner control. There's no stock issued, so your ownership does not change. Interest that we pay on those bonds is tax deductible, whereas when we pay dividends to our shareholders, those are not tax deductible. And then bonds can increase the return on equity. Again, because bonds are a liability, it doesn't change your equity at all. If you're using that money you raised from bonds to expand and increase your net income, that equity stays the same, that return on equity is going to increase. The disadvantages is that they obviously have to pay interest, and they have to pay back the amount that they owe at the end. Bonds can decrease the return on equity if the interest expense would be too high and then your net income didn't go up. But again, we're hoping that if you're borrowing the money, you're doing something good with it, right? So if you were to look in the Wall Street Journal and think, okay, I want to buy some bonds. So here they show you how you'd see it. So these are IBM bonds, and the close is 103.08. That is not dollar amount. It's not saying it closes at $103.08. It's saying it's 103.8% of the face value, and the face value of a bond is always $1,000. So if the company issues out bonds at par value, they're going to receive the cash. So in this case, they issued bonds at a par value of $100,000, a rate of 8%, and then they're maturing in 2 years. Now these ones pay interest semi-annually, so they could pay it annually, could pay it semi-annually. So just read the problem to make sure you know. So cash comes in, and then we set up a bonds payable. Now again, it's going to be 2 years out, so it's long-term debt. Then at the end of those 6 months, we're going to pay one of our interest payments. So we debit bond interest expense and we credit cash. So the par value times the coupon rate times half of a year, or you could put 6/12 if you like that better. But that's going to be $4,000 that we'll pay out in interest. Then at maturity, we pay off the par value of the bonds. So cash goes out, $100,000. Bonds payable are removed from our books by debiting. Now, where it gets a little tricky, and this is more actually common, is that bonds really aren't sold at their par value very often. They're subject to what's happening in the market, so they sell at either a premium or a discount. So if what the bonds are paying, if the coupon rate or the contract rate in the bond is greater than the market rate, everyone's going to want those bonds because they're paying more interest than any place else in the market, so the bonds are going to sell at a premium. If the coupon rate or the contract rate was equal to the market rate, then they really would sell at par. If that coupon rate or that contract rate is less than market, then no one's going to want to buy those bonds. The price of the bonds is going to have to go down, and they will sell at a discount. So we'll do an example of each. So the discount bond, the issue price is 96.4% of the par value, and again, it's because they are paying 8% and market is paying 10%. So nobody wants those bonds, so the price has to go down. So we can take the 96.4% times the 100,000, and that's how much cash comes in. We always put the face value or the par value as our liability, because that is what the company is legally obligated to pay back at the end. It doesn't matter what people pay them today. They've got to pay the $100,000 back. And then the difference is going to go to a discount account. So if we were to go to look on our balance sheet, we'd see the bonds payable less that discount, and then the carrying value of the $96,400. Now then, what we do when we get to the end of the year, or the end of the semi-annual period, when we're going to pay the interest, the $4,000 is still the payment. So it's still the 100,000 times the 8% times 6/12 or a half. But then what we also have to do is deal with this discount on the bonds payable. So we're amortizing that. So we take the $3,600 and we divide it by those 4 interest payments. There's 2 years to maturity on the bond, and it pays interest semi-annually, or twice a year. So 4 times. So the $3,600, divide that by 4, gives us this $900. And then here they show you how we would amortize it out. So each interest payment, we're going to amortize or take $900 out of that discount until when we get to the end of the life of the bond, the discount is fully amortized. And again, it's charged off to bond interest expense. Now here, what if it sells at a premium? What if it's the other way? So market rate's 10%. These bonds are paying 12%. So everyone's going to want them. They're going to pay a premium. So then so go back, they're selling, it tells us they're selling at 103.6% of the 100,000. So then that means $103,600 cash comes in. Again, the company still just owes the par value, the 100,000. The difference is a premium, and that we set up. And then again, how we do the carrying value is still the same. Bonds payable plus that premium gives us the carrying value. And the cash comes in, we record the premium. And then now when we amortize it, it's very similar. We look at, okay, our premium is $3,600. We divide that by 4, it's $900, but then notice it goes the other way. So the premium on the bonds payable is currently a credit. When we amortize it, we're going to have to debit it for $900. So that's going to reduce our bond interest expense. So we are still paying the cash, 12% times the 100,000. Now that increased, because of to make it the premium. So we're paying $6,000 each 6 months, and then we're amortizing the 900, and then what's left is going to go to bond interest expense. And then again, here they show you the amortization of it slowly. Over the life of the bond, we bring it down to 0, which means at maturity, all that's left is the $100,000 that we owe. And then at retirement, when it's mature and we need to pay it off, we're going to credit our cash for the $100,000 and then debit the bonds payable. And again, that premium or discount would be fully amortized, so that would not impact our entry. Now, what if we retire them before maturity, which we could do? We call those bonds, if they're callable, the company could choose to call them in. So if it says the bonds have a carrying value of $104,500, and then there's a call premium of $3,000. So that means they're going to have to pay $103,000 to call those bonds in. Now we're taking the bonds payable off of the books, the $100,000. We're taking the premium off of the books, $4,500. So what we need to make this entry balance is a credit of $1,500, and then that $1,500 is going to be the gain on the bond retirement. So we are getting rid of a liability that's worth more than what we're paying. So bonds are a little tricky, but again, we'll do some of those and you'll see those worked out. Our long-term notes payable are the same as the short-term notes payable, except for now they're going to go more than a matter of days. They're going to go years. So again, though, we're going to record interest, and then we're going to calculate out oh, here they're having us actually calculate the payment. So what we have, this is an installment note. Let me go back. Yeah, that's the long-term notes payable. Okay, so this is a different topic. So now our installment notes, those are like if we get a mortgage or we get a truck loan, or in this case, it's going to be loan on equipment. So when we have installment notes, that means we're going to make payments, and those payments are not just going to be for interest. They're going to reduce the principal balance of the note payable and also charge out interest. So we can use our time value of money keys to calculate out what that payment is. If we know we're borrowing $60,000 at 8% and we're paying annual payments, we can put those into our calculator. So again, I'm not going to use these tables. We're going to use the financial calculator. So the 60,000 would be our PV. The N would be 3. The IY would be 8. No future value on a loan, and we'd compute the payment. So we'd get the 23,282. And then if we would go into our amortization function, we would then hit the second menu button on our calculator and then go into that amortization function, which is above the PV. And then we could amortize the 3 payments to say, okay, out of the first payment, how much goes to interest, how much reduces our notes payable, and then we're always making that same payment amount. Then we could go down into payment 2. How much went to interest, how much reduces the notes payable, and then what's our balance on our note. Then what about payment 3? How much goes to interest, how much goes to principal, and then it's fully paid off. So when we do these installment notes, I'm going to do them using the time value of money keys on our calculator, just like we do in business analysis with algebra. And when we amortize out these payments, I will use that amortization function. So hopefully everybody is comfortable with that. So then what we do with our journal entry, though, is our journal entry, the cash is always the amount of the payment. It'll change based on how much goes to interest expense and how much reduces the liability. If we look back at that amortization function again, or table, this is all the amounts that's going to go to interest expense. These are all the amounts that are going to debit our notes payable. So if we come over here, then you see them doing that. Mortgage, again, same scenario except for longer term, and the building is going to act as the collateral on that mortgage. So then some features of bonds. So bonds can be and notes could be secured or unsecured. So the notes is probably more common for the secured and unsecured. So secured means there's some sort of collateral backing it. Bonds can be convertible or callable, so they can convert into shares of stock, or they could be called early. They could be term or serial bonds, and then they're registered or bearers. So registered is to a person's name, the bearer is to whoever holds the bonds. Our debt to equity ratio is our total liabilities divided by our total equity, and that will give us a percent. And then again, they're showing it as a more 1-to-1 ratio, I guess, if your liabilities are more than your equity. But if you did this as a percent, it'd be 162% or 130%. But I guess leave it in the decimals, since that's how they're showing it to us here in this exhibit.